Are your investments keeping you up at night? Hey folks, welcome back. Thank you for joining us. This is Master Plan Retirement Consultants Retirement Roadmap. My name is Evan. Joining me as always, retirement planner Mark Fricks. During this episode, we'll examine several common investment behaviors that may undermine your retirement security. Mark, we're going to be talking about a lot of preconceived notions, but also just general attitudes people seem to take with them into retirement that lead to some pretty common mistakes.
Sometimes it's misinformation, sometimes it's old way thinking, a lot of times it's emotion.
A lot of this is going to be emotion,
Absolutely.
actually.
So a great topic, I think, and we have some great examples of it.
Sure.
Things happening as well. So
Well,
look forward to it.
Emotion is a perfect segue for the first topic, and we've had an entire episode on this first bullet point, and that is holding too much cash out of fear. Holding too much cash feels like safety a lot of the time, but we know that due to inflation, that can quietly erode your purchasing power over time.
Yeah, so often we have folks come in and we'll be doing their financial statement, and there'll be a big chunk of money in cash, and sometimes we didn't know what to do with it. We got an inheritance or whatever, and we just put it there and parked it there. And I said, when does that happen? Oh, 4 years ago, or whatever it may be. And other times, like you said, it's fear of the markets, fear of not knowing what to do with it. I think we've talked about the color of money before, right? We label cash as yellow money. Yellow to me means caution, like a caution light. And so it feels comfortable, it feels good. Hey, all I got to do is reach into that bank and pull out whatever I need. But you're losing money every year, purchasing power. And don't confuse cash with liquidity. Some of that money can be moved to something that's conservative, liquid, available very quickly, but making certainly more money than inflation. So it's very easy to fall into that trap.
And not to talk down to our listeners or our viewers, but can you explain how purchasing power works and why our money is we are losing money in a cash position?
Yeah. So first of all, checking pays what, 0.05 if you're lucky, right? What is inflation? Well, right now it's running above 4% over the last 6 or 8 years. It's been in the 4 to 6% range. People say, well, I have a high yield savings account. Yeah, they're paying 3 to 4, maybe 5. But inflation, those are always going to lag behind inflation. If you look at your high yield savings over the last 6 months to 9 months, it's pulled back. Yep. And it's not paying what it was because inflation pulled back. And so if you're just continually falling behind and you look at a significant amount of money, whether it be $50,000, $100,000, or whatever it may be, we can run the numbers. You'll just see that gap getting bigger and bigger of what you should have versus what you really have. And so it's critical. It really is that you make some money on your money, put your money to work. I'm not saying throw it into penny stocks. I'm not saying throw it into some aggressive portfolio, but as you know, and as our listeners know that are loyal to the show, is we kind of stack portfolios. We'll have one checking. Then we will have a savings backup. Then we'll have a very conservative portfolio. Then we'll have a little bit more moderate portfolio, so forth and so on. So that extra cash, and then you also have to consider, and we may get into this, the tax implications too. If we're going to make more money on it, should we shield some of that from taxes as well? So that's something else to think about. But sticking to this first bullet point is put your money to work.
Yeah. And a cash reserve also tied to a specific time horizon tends to reduce your anxiety rather than amplify it. So if you know you're going to need cash in the next 6 months, that's probably a good reason to keep it into cash, or at least something that's extremely conservative, like money market or something like that. But then when you start to stretch it out, then you can say, well, let's make our money work for us a little bit better. The portfolio I'm going to use for 2 years out is going to be more conservative than the portfolio I'll use for 5 years out. So the time horizon is important to consider. And just as you said, we are not saying not to have a backup of cash, emergency fund, things like that. But we see too often way overweighted in cash for most people. Another point that you brought up that before we move on to the next subject is liquidity. People think that cash, that means they can get to it. If it's in the market, they can't get to it or somewhere else, and that's just simply not true.
Right. And the first thing we'll ask them when we see a lot of cash is, what is the purpose of that? And they may say, we're buying a car in 4 months or whatever. And like I said earlier, we don't know what to do with it, but that's the first question is what is it for? Then we can determine, like you alluded to, where to put it, what's the time horizon, things like that. Maybe this cash can be divided into 3 buckets, one for the next 6 months to a year, one for 1 to 2 years, one for 2 years to 5 years, or whatever it may be. Yeah. So again, it's not just a, hey, let's move it somewhere or let's keep it where it is. It's got to be more strategic than that.
Yeah. Point number 2, timing the market instead of staying invested. We see that, I saw this week. I see it every month, possibly more than once, and I talked to somebody who recently had an old advisor who did this for them, which is crazy, but selling after a market decline.
And that was an advisor.
And that was an advisor who did that for some of their accounts. So selling after a market decline locks in losses and increases the potential of missing that rebound. Now, timing the market instead of staying invested, there's a saying, it's not timing the market, it's time in the market.
Right. Yeah, I think, I don't remember the statistic precisely, but if you miss, like during the course of a year, there are like 5 to 7 days where the gains come, typically. And so and I've got a graph that shows what if you miss the 10 days, what if you miss the 20 days. Now, I will say this, we do a lot of trading when there's changes in the environment, but we're not moving to cash.
Right.
We're moving to a better position, just like when the Iran war began, the saber rattling, we had a lot of our money managers move from something like, I don't know, Walmart maybe into Lockheed or something like that was more about making missiles and jets and things like that. And we've made a lot of money doing that. So it's not about switching positions necessarily if you know what you're doing, but it's about just collapsing into cash. More cash went out of the market between 2008 and 2010 than the history of the stock market.
Yeah.
So one of our worst years is when people just vacated, and they didn't vacate at the beginning. They vacated, near the bottom.
Yeah.
And a lot of them, as you've seen, for years stayed in cash because they're scared to death because of what happened. If they'd ridden through that, they would have broke even. I think it was like 4 years, 5 years later. And then we've had such tremendous growth since that time. If you've not been invested, you have missed hundreds of thousands of dollars of growth.
Yeah. We've had a couple of clients call, and last year there was the big kind of shakeup. We had a bit of a market drop, and we had a couple of calls. There was a lot of uncertainty, and there were a couple of folks we had to talk off the ledge a little bit. But again, that's fear-based, and that's reacting off of emotion. And one of the ways to combat that is, yes, we do need to adjust allocations, but adjusting them deliberately serve retirees so far better than jumping in and out based on headlines. And just as we mentioned previously, you have different buckets, different accounts with different levels of risk, with different time horizons. If I've got this is an extreme example, but if I've got a Roth IRA, or that is I'm not going to need for 10 plus years because I'm expecting taxes to be to be higher in the future, so I want some tax-free money available. That's 10 years away that I'm going to need that, and maybe it's in an aggressive account. Well, if we've got a rocky month in the market, I'm not going to divest that 10-year bucket when I've got 10 years of growth, when I know I'm going to have a bounce back from this drop. So it's thinking more deliberately about what's the time horizon of each account, what is the goal, what is the purpose. There's a lot to think about.
Well, I'll tell you what else has really hurt is social media. I've got several clients that, hey, I just saw this on my news feed. They say on June 19th this is happening, and you better be out of the market or in the market or in gold or out of gold or whatever. And it's just somebody trying to get clicks. Yeah. Is all it is. And I'm not saying there's things happening, but there's been things happening for the last 100 years. And it's just more technology, more things going on. And again, our money managers are using computer-driven programs and algorithms to make adjustments, but it's not based on a news feed. It's based on actual things happening in the market and around the markets. And so it's so easy. I have one client that probably once a month will send me a link and saying, is this true? Do I need to do this or do I need to do that? And I'll look at it, and again, it's just somebody trying to get clicks or subscribe to my bulletin or whatever it may be.
Yeah. Well, that's exactly our next bullet point, and that's overreacting to short-term news. And just as you said, we definitely have a handful of clients who are hey, did you see this article? Have you heard of this guy? Have you heard of this? That would drive me crazy in retirement. Retirees who check their portfolios daily could feel more stress and could make more reactive decisions. And also, part of us becoming retirement planners is to provide peace of mind for folks so that you don't have to worry about where your next paycheck's coming. You don't have to worry so much about what's going on with my money. Because you have a written plan. You know the job of every account. You know the job of every dollar. You know how it's going to be used, when it's going to be used. And you know the protections that the plan has put in place as well.
I have a couple of clients that they keep this Excel spreadsheet, and every month they get their statement. They write down what that account was worth. And so they'll call me up and say, well, it was worth 5% less than it was last month. And I said, well, let's look at the last 2 years. It's up, 32% or whatever it may be. You can't look at it's almost like planning a journey of 100 miles and after 3 steps judging it.
Yeah.
I'm behind schedule. I've taken 3 steps and you can't do that. And again, it depends on the time horizon. I know that's important, but we're not going to get the volatility in the short term, less risk as well. So it is something that you have a strategy. You look at the history of that portfolio. You look at how the money managers work, what their job is. And I love the fact that we use different portfolios, not only because of time horizon, but because of different flavors of the market. Some markets, this portfolio would do better. Some markets, this one would do better. So if you got 5 or 6 of these, there's always something making more money than the other one as well. But this short-term thinking, reaction, that's really part of our job. Is the reason I joke that we have a first floor office is if a client jumps out the window, they're going to be okay.
Yeah.
But it is a short-term reaction, and I get it. People have worked 40 years for this money, and they have strived and worked and saved and been disciplined, and they don't want to see it evaporate overnight. But what we're doing is not going to make that happen. What they're doing may make it happen.
Yeah.
So that's the issue.
Yeah. I do want to take a moment, folks, to refer you to our website, masterplanretire.com. There you can schedule your complimentary consultations with us. It's an opportunity to discuss your retirement, your hopes, your dreams, your fears, and your goals, and get an outlook, 10,000-foot view of your own retirement. What does it actually look like? How does your money actually work for you? What are your strengths? Where are your areas of opportunity, of improvement? And that's completely complimentary. So take us up on that. That's masterplanretire.com, or call us at the office, 770-980-9262.
We have a website?
I believe so. I hope so.
If you go to the website, there is a little button. I think it's green.
Schedule
I'm
now.
kind of colorblind. I'm not sure. But it says schedule now again, and our calendar pops open. And, don't be afraid. I said this, I think, a show or two ago. And I realized when you make an appointment with us, you're kind of revealing your financial soul. And I know that can be difficult because everybody has had failures. Nobody feels like they've done as well as they could have done. It's true for everyone. So let's take it from this point and see how we can do better. So don't be afraid to schedule that. Some of you have been putting it off. We get calls all the time saying, your number's been on my dashboard for 3 years, and finally I'm calling you or whatever. So be proactive and take care of that.
Excellent. The next bullet point, ignoring tax efficiency in withdrawals. This is a big one, and not as much attention is put on this by many people, even by some advisors. So not all retirement dollars are taxed the same. Taxable accounts, traditional IRAs, Roth accounts, each behave differently. Having a withdrawal sequencing strategy in place before RMDs, required minimum distributions, could also make a huge difference. But knowing the tax environment you're in when you're making those withdrawals, it's incredibly important. And it's also complicated, and it's different for everybody. The timing is different for everybody. It requires strategic planning.
This could be a whole show, and maybe we've done some of that before, And so there's so many things to consider. I'm just going to throw in a couple of things you have to think about. Number one is, like you just said, what is your tax situation this year? Because I'm a fan of spending down the IRAs early while taxes are still low. Does that mean we take out $50,000 when your income's $300,000? No, probably not. Every distribution that comes through our office passes through Evan or I first to look at the best place. Maybe we've got an account that has really grown well. Well, let's take some of those profits out because now we're over loaded in that particular type of portfolio. So there's so many things to consider. That's why folks say, well, can I do my own distributions? I said, absolutely, sure, money. Let me tell you why maybe you should let us help you with that, okay? And number one, we track it, but number two, being very strategic. If you've got these 15 different areas where you can, have somebody help you do better, think of the difference it will make in your retirement long term if you fine-tuned all these areas. One of those areas, not so small, is, like you said, distributions. Tax-wise, growth-wise, portfolio-wise, all of that comes into play.
Yeah. Well, even just like your team analogy, if you make every player 10% better, you've got
11 football players. If you make every one of them just 10% better, your team's now over 100% better.
Yeah.
And so every little piece of your retirement puzzle, which we're certainly not talking about all that today, but that is a big one, distributions. And again, everyone that comes through here passes by one of us to determine the best place to take it from.
Yeah. And we've been talking a lot about the market, but this next topic is relying too heavily on the market for income.
Yeah, this is called the sequence of risk of return. And so we've talked a little bit about this before. So
Risk of sequence of returns.
Risk of sequence. Did I say that backwards?
Sequence of risk of
There's
returns.
a risk with a sequence of returns.
You can Google it. AI will sort it out for you.
Right, we'll send you a free report. I can't say free, complimentary. So basically, just imagine, a lot of people say, well, the market averages 8% a year. That is the average. But that doesn't mean it does 8% every year.
Right.
One year it's going to do 18, one year it's going to do a negative 12. And so that's why we are firm believers in not using the market for income. Imagine retiring in the year 2007. You're taking $25,000 a year out of your 401k, and the market dropped 56% over an 18-month period. And you're taking money out? It's not going to work. You're going to run out of money much quicker. So that's why we want stable areas to take income from. And then with the market being fluctuated, that's for those extra items, not the power bill, not the car payment. These are for things like I want to go to Europe, we need to repair the roof, things of that nature, those once a year, twice a year money that we can pull out and determine where to pull it from, as opposed to waking up every morning, pulling up your Schwab account online saying, I hope it's up today because my check comes today, or whatever it may be.
Well, and we also have heard the argument a lot before, well, I'm using fixed income securities. I know what I'm getting. I know this percentage, but even that is not immune to economic swings.
No. If you're buying individual bonds, they're going to hold their value, but they're not liquid. So if you're taking money from some type of a bond portfolio, first of all, they just don't make money anymore. The bond portfolios I look at are earning 3 to 4%. That's even with bond trading, but they can lose money. Bond accounts lost money definitely in 2022. Yeah, when the Fed raised rates very quickly. It killed existing bond prices and trading. And other people talk about dividends. Hey, I'm going to put up a dividend account. Dividends are going to average 3.5% to 5%. Well, number one is we can produce more than that using some of the tools we use. Number two is dividends aren't guaranteed. And when the economy gets bad, the market gets bad, dividends go down. Some companies cut back on them because dividends are just basically a sharing of profits by the companies you own. Well, if their profits go down or disappear, they're not sharing profits with you.
Right.
Okay, so it's dependent again on the economy and whether we're in a recession or a bad market or whatever.
Yeah. So making sure that we have a withdrawal strategy and we're not relying on the market for guaranteed income, because there is no guarantee within the market. If you need guaranteed income, there are other sources that you would need to go to for that purpose. The next point is failing to rebalance consistently, and you already mentioned this previously too. Maybe you've had a really good market year, and so this account has grown really well, but now you're way overbalanced in stocks, and then we have another market swing, and we haven't rebalanced and maybe moved some of that back into another holding. You need to rebalance, not all the time. Again, we're not watching the market, but without rebalancing, your risk is going to drift with the economy and the market shifts. After bull markets, portfolios could become stock heavy. After downturns, people become too conservative. So systematic rebalancing may help maintain the intended risk over time. And our portfolio managers do that already. They have systematic with rebalancing built in.
But I'll tell you where it becomes very strategic as opposed to systematic is recently a great example. We've had clients we've put into gold and silver portfolios since 2014,
Sure.
2015, really since 2010. And so since that time, depending on when they bought it, it may have doubled, it may have tripled, it may have quadrupled. Now instead of having 10% of their holdings in precious metals, they've got 25% in precious metals. Now I love precious metals, but that's too much in one category. It's kind of like the folks, and I respect you, please, but that have all their holdings in rental houses or rental properties. I think that's a great investment. But to have all that, I had a friend of mine that had 20-something investment properties and lost most of them in 2008, 2009, 2010. And he came to me and said, you know, you've been talking to me for years about having everything in that. I just lost it all. I'm starting over. And so that's a rebalancing thing, you know. So it's too much of anything's not good.
Yeah,
Right?
100%. Couple minutes left, and that's perfect timing because we are on our last point, and it's neglecting to adjust strategy over time. That's why we make a written plan that is dynamic. You know, life changes, your plan needs to change. Even a portfolio that made sense at age 55 or 65 might not be the same or the same fit, the right fit at 75 or 85. So making sure that your strategy is evolving with your life.
Yeah, clients that have been with us 10, 15, 20 years. You look back, you know, when we first started working with them, things are totally different. Age, needs have changed, goals have changed, maybe a spouse has passed away. I mean, anything. Sometimes it's just aging.
Yeah.
Needs become different, whether it be income needs or whatever. So it is like I think you've said before. It's kind of like the Constitution, or it's a living, breathing document, or whatever it may be. So, but it is something that's got to be changed, and that's why we meet officially at least once a year to make those adjustments. Sometimes we'll meet more than once a year, depending on needs and things of that nature. But it does have to stay in step, and also, you know, we have changes in law. You know, every year or two, it seems like we have a change in tax law or Social Security law or anything related financially. We've had Secure Act 1, Secure Act 2. These all made changes in all kinds of retirement accounts and things of that nature. And so that also requires an adjustment many times.
Yeah, and we write the plans to be flexible, but they are long-term, full-life plans. But they have to be made flexible because life changes. Once that plan is in place, we also make it as close to mandatory as possible to meet with our clients at least every year, if not more, to see, okay, where do we need to adjust this? What's going on with life? And we definitely have clients who are like, I'm set, I'm going to RV for 2 years, I'll see you later, that's fine. But we really need to make sure that we're updating that plan, making sure we're checking in. Are you getting enough income? Do you have too much income? Can we pull back a little bit? You know, how are things going? How's health? You know, there's a myriad of different lifestyle changes that could happen, but making sure that we are adjusting where those changes were needed.
Yeah, I really enjoy the annual reviews because I hear the things that are happening in their lives, the changes, some bad, some good, but it's interesting to me to look at their plan and say, these are 3 things we could do that would really be powerful for you because of the changes. And so that makes those annual reviews very interesting. Plus, our clients become friends.
Yeah.
They become very close to us. We know more about them than sometimes their kids do, financially, definitely. So it's really interesting to get back but see where they're at in their lives.
Yeah, absolutely. Well, this has been a good episode, folks. Thanks for joining us today. Remember, go to our website, masterplanretire.com, to schedule your complimentary consultation.
And until next time, remember, plan well and prosper. Take care.